As I was saying, protective puts. How many of you own stocks? Everybody, right? Maybe it's in a 401k, and maybe it's not everybody, right? Folks who, um, there's a lot of folks who don't, but many of you probably do. Well, what happens when the market goes down? You lose money on those stocks you own. Options can be used to help protect those long-term holdings, stocks or ETFs or futures. But here's the thing. Protective puts, when I talk about trade-offs again, protective puts have their issues. And so the strategy really needs to be structured correctly. Now, when you read about hedging stock, the first thing you're ever going to read about in a textbook or online is protective puts. That's when you own a stock and you buy a put, typically out of the money is how people typically do it. Doesn't have to be, but generally. And that limits your risk, but it limits it at a potentially really big, dare I say, oppressive cost. If we're going to buy protected puts, we want to limit our downside risk potential on a stock that we own. So we buy a put option on that same stock. The put owner will then have the right to sell the stock at an agreed upon price, the strike price on or before the expiration date. So let's take a look-see poo at how this looks-see poo. Excuse me, 1 second here. Okay. So let's say for a moment here, please. Let's say for a moment that you own 100 shares of the SPY ETF at $679 a share. Well, we can protect it by buying, say, for example, the November or whatever month or week or whatever, 669 puts and pay $5.27. So there's a lot going on here. It's kind of like buying an insurance policy, right? Isn't it? The dotted line here, back to checker squares, because it's strategic, because investing in stocks is strategic, but not as strategic as options. Goes up above 679, we win. Below 679, we lose. Well, let's first look at the whole reason for buying the darn thing, the put, to protect ourselves. So, like any other insurance policy, we've got a premium we pay, same word, incidentally, right? And we've got a deductible. Let's start with the deductible. What's the deductible on this insurance policy? Well, it's $10. Why? Because if the stock fall, or if the spiders fall from 679 down to like 670, if it's still above the strike price at expiration, that put's not doing us any good. The premium we paid ended up being an expense. And we lost, in this example, $9 on the ETF. So really, it's the first full $10 that's on us. Unless the spiders are below the strike price of 669 at expiration, the puts don't do us any good because we can exercise our right to sell the shares at the strike price of $6.69. So the deductible, the first $10 is on us. And the premium is sort of like expensed regardless to boot. So really, we can lose up to $15.27 on this. Now, if spiders fall 20 bucks, 25 bucks, 30 bucks, 40 bucks, full correction, 68 bucks, I'm really glad that I only lost $15.27. But you think about it, that ends up being, well, it's a little less than 1%. These are pretty cheap puts, but you know, I guess when we came up with the example, there probably was only like a week or two until expiration. We're going to look at, we're going to look at, well, I guess we are looking at some real examples. Hold on a second. Let's go back for a second. Oh, it doesn't say how many days till expiration. Drats. You know, we could, here, hold on a second. Let's just take a little look at something here. Well, hold on. We'll look again in a second. Yeah, we'll look again in a second. Okay, so that's the most we can lose. We can lose 2.2%. We have protection. Oh, that was for 30 days. Okay. So 15.27 divided by 679 is 2.2%. Actually, it's not really that bad for a market that moves like this market moves. But here's the rub. Here's the problem. You know? Oh, hold on a second. Oops. Here's the problem. This is for 30 days. We love having that protection for 30 days, don't we? What do you think if we just buy a put like this every month, every 30 days? Then we're protected all year long, right? Well, 2.2% times 12 months means I'm guaranteed to lose 26.4%. Well, I guess that's if it, that's including the deductible. Hold on a second. If we just include the insurance, so 5.27 divided by 679, so that's just under 1% times 12 months. I'd be guaranteed to lose 9.3% a year if I bought a put that worked out to be, on average, this price every 30 days. How much does the S&P 500 historically make, not inflation adjusted, a year on average? About 10%. So with this strategy, if we held it for 30 years, in theory, and obviously not guaranteed, but we would make 0.7% a year, we would massively underperform everybody else. We would compound our money at a massively slower rate. And inflation, by the way, has historically been held pretty close to 2%. It's higher now. So we would actually lose real value if we bought one of these puts once a month. This is a terrible strategy. And in a lot of ways it is. And that's why we're talking today. If the shares are above 679, we're still losing that roughly 0.8% because this 527 is a cost regardless. That's how I ended up with the numbers I ended up with. Couple of key implications here. I guess, yeah, I already sort of did the math for you. I think John's math is wrong. 9.3%. Hey, okay. So let's talk about overcoming cost. The expense of the puts can, even though they're oppressive, they can be creatively overcome. What we do is we finance the put by using covered calls. Now, this, friends, is something that is near and dear to my heart. Covered calls, the topic of my upcoming book. So, a covered call is when you own shares of stock and you sell short a call, typically out of the money. Now, this is kind of in a lot of ways the opposite of a protective put, but it kind of has some commonalities too. We collect a premium here, which is the opposite. We limit our upside profits instead of limiting our downside risk, which is kind of the opposite. But it actually gives us a little bit of protection to the downside too. Let's take a look at this. There's a lot going on here, right? Like I said, checkers and chess. Let's say we want to generate income. We're okay limiting upside potential. And this is just covered call. We're moving away from the protective put for a second. Okay. We want to generate income. We're okay limiting upside profit potential because we don't think the stock's going to go up above a certain point. So we sell a call option on that stock that has a strike at that certain point. So the call seller will then have the obligation to sell the stock at the strike price, and that obligation will be had until the expiration date. So let's say I own 100 shares of the SPY ETF Spiders at 679. And I think it's not going to go up above 689 over the next 30 days. So I sell the 689 call at $4.99. Well, now I end up with something like this. If the stock is below, well, okay. It was at 689 when we, or no, it was at 679 when we did this. If the stock stays at or below 679 by expiration, we get to keep that $4.99. So we actually outperform simply owning the stock. And if stock is above there, all the way up until 689, same thing. But if the stock is above 689 at expiration, the call strike, because we're short 100 shares, or excuse me, because we're short one of those calls, we have the obligation to sell 100 shares at 689, which is, hey, 10 bucks higher. I make 10 bucks on the stock, but then it gets called away. It gets sold at 689. And I also get to keep that premium I collected when I sold short the call of 499 to boot. So I make 10 bucks on the stock. I get to keep $4.99. I make $14.99. Okay. So I'm able to bring in 0.74% from the call premium over the next 30 days. It's just that I have limited profit potential. So, this is not something that I always want to do. The best case scenarios, I make about 2.2%. The call premium plus the rise in the stock price, or basically 14.99 divided by 679. Okay, so hold on a second. We might actually be able to use this for to help us with the protective put, right? Premium, we make 0.74% over 30 days. We collect a premium. We still have the downside risk with the covered call. We give up some upside profit potential with the covered call. This is one of those, you put your chocolate in my peanut butter. You got your peanut butter on my chocolate. And you have the perfect Reese's peanut butter cup. And in options, that perfect Reese's peanut butter cup is called collars. A collar is a strategy that can help protect long stock or futures at a very, very low cost. This is an investor-oriented strategy, not a stock trading strategy, not an options trading strategy, but a stock investor strategy using options to make it potentially, in some ways, better. So the collar is just doing both of these things at the same time, the protective put and the covered call. I'm long 100 shares of the stock. I short one out of the money call, and I buy long one out of the money put. So I'm getting limited risk from the put, but limited reward profit potential from the call. The whole rationale of collars here is that I want to limit downside risk potential on a stock or ETF that I own. So I buy a protective put, but I don't want to pay for the put. I want to put, but I don't want to pay for a put. It's like the government. I don't know. It's kind of like the government, isn't it? We'll just print money to pay for the put. Just kidding. I don't know. I'm going off on a tangent here. No, we're not going to print money. We're going to collect money. To pay for that put, we're going to sell a covered call to help finance that put. The money we take in from the call is pretty similar, probably a little less, but just a little less than the money we pay for the call. So I'm going to have the right to sell the stock at the put strike price and the obligation to sell the stock at the call strike price. All right, what does this look like in real life? Let's take a look here. So I own 100 shares of SPY at 679. And I'm going to buy that November 669 put at 527. And I'm going to sell that November 689 call at 499. So I'm paying 527 minus what I'm collecting, 499. I'm really paying a total debit of 28 cents. That is all this costs me. So I end up with this. If you look down towards this end here, the lower stock price end, this looks kind of like the protective put hockey stick, doesn't it? The stock can fall from 679 to 669, and I can lose $10. And that's the same as it was with just buying the put. But what I paid for the put got financed with the call. I didn't pay 527 for this position. I only paid 28 cents for this position. So I can lose the $10 on the stock plus only 28 more cents. I'm saving about a third of my risk. Or if we look at it as just purely the cost, I'm saving 95% of my cost. It's just the deductible. It's like, health insurance or car insurance. I still have that same deductible, but my insurance premium shrunk by 95%. It's kind of like the opposite of real life. To the upside, I still get to make that $10. I don't make quite as much because the $4.99 is a little bit more than offset by the cost of the put, but the covered call component, we're not actually trying to make money on the covered call component. We're only selling the covered call to finance the put. We're allowing the situation where we're giving up a little bit of upside, because if the stock is above 689, we stop making money. But we can still make $10. Moral to the story, we can only lose 1.5%. And we have protection for 30 days. But we can only make 1.4%. And we have that limitation for 30 days. Now, in this case, it's a measly 28-cent debit, which is just like, spillover. That's like, go to the bar, you order a martini. If you go to a good bar, they fill it all the way up to the top. And inevitably, you take that first sip and like a little tiny drop comes out. You're like, no big deal. And drink your martini. That's what this is. This is like that little tiny bit of your martini that you accidentally spilt. It's 28 cents. It doesn't matter. It is possible that if I chose a lower strike call, I could have taken in more premium, and I could have actually potentially even gotten a credit. That usually doesn't happen. And by the way, there are some stocks where the vertical skew, the volatility skew, is higher for the calls, and you can still do equidistant strike price, like $10 higher, $10 lower, and still maybe taking a credit. But that's a little out of scope of what we're talking about here. And this is kind of what I'm talking about here. We can change the strike of the calls, or we can change the strike of the puts. We were using the 669 puts, buying those at 527, and 527 minus 499 is 28 cents debit. If we bought, instead of changing the call strike, we changed the put strike, We could have just paid $4.79. We actually would have ended up with a 20 cent credit. Collect $4.99, pay $4.79. But then we have an extra $2 of risk to the downside. Is it worth it? It's situational. I mean, there will be times when you feel that is worth it. But to me, 20 cent credit, 28 cent debit, I don't care. So, collars can be established at a debit or a credit, or, it's always nice to have like close to a no cost, or they call it a zero cost collar. Collars are usually established longer term, sometimes even using options with a year to expiration. And here's a big secret. Write this down. If you're taking notes, write this down. Collars work better the more time there is to expiration. Collars work better the more time there is to expiration. And there's reason for that. Stay tuned for the reason. Remind me the reason. I'm going to write down reason. I might forget what reason means, but you'll remind me. So here's like a 43-day example. The stock is at 270. So we go $20 lower, $20 higher. This is Apple stock, by the way. Obviously, prices are not current. This is a screenshot from the past. But we can go, and to be 100% clear here, it's not exactly $20 higher and $20 lower. It's actually $19.65 higher and $20.35 lower. So a little bit more room for the stock to drop to the downside. Difference of a total of 70 cents. But this is one of these situations where we only pay a penny debit. And that's really nothing. If we go out 224 days, stock's at the same price. We could do one of two things. One, if we did do the same strike for both of them, the 290 calls, we would take in a big credit. We would collect 1610 and pay 1225. Or we can sell a higher strike and give an extra $10 room to run to the upside and do that for pretty close to zero cost. Still taking in actually a credit, but 25 cents. So we can kind of do it one of two ways. We can take in a credit, or we can sell a higher strike call. Interesting, right? Now this is versus, just buying the put, $12.25. That's a lot. Now, 224 days, that's like 3/4 of a year or 2/3 of a year or something, right? About 2/3 of a year, 8 months. But I mean, still. Now, let's go back to this one for a second. And let's look at this from the perspective of not the one in the green circle, not deciding to buy a higher strike. I mean, I personally, I would rather buy a higher strike, or excuse me, personally, I would rather sell a higher strike to give more room to run than collect credit. Because if I didn't, because why am I doing this? If I'm putting on a collar, do I think the stock is going to go up or down? Do I want the stock to go up or down? Who can tell me? Hit that questions box right now. Do I want the stock? Do I think the stock will go up or down? Up or down? Got one answer. We got two downs and two ups. Here's what we're going to do. We're going to have a tag team cage match. The ups versus the downs. Well, it's a it's a tricky question, but once you think about it more, it becomes a little more clear. We actually want the stock to go up, but we're afraid the stock will go down, right? Because let's face it, if I thought the stock was going to go down, I would just sell the stock. I wouldn't accept $10 worth of risk to the downside. I would sell the stock. There's a lot of caveats to that. Like if I inherited it from my grandfather, who originally bought it at a cost basis of 2 cents, back when Steve Jobs and Steve Wozniak were hanging out, smoking pot in their garage, building computers with their friends, not taking showers and all that. If you have a big cost basis like that, and like you're going to have to pay tax on the full value of what you sell it for, okay, that's a different story. But under most circumstances, taxes and commissions and all this stuff aside, if I thought the stock was going to go down, I wouldn't do this. I would sell the stock. I, if I really thought the stock was going to go down, I would sell the stock and then buy puts. So I make money if it goes up. So I must want the stock to go up. I either think it's not going to go up too much above the call strike, or if it does go up above the call strike, I don't care because I'd sell it there anyway. Or I'm a savvy enough option trader where I know some adjustment techniques and can roll the call strike and, kind of solve the problem and do some damage control. Okay. So I said before, there is a reason, there's two reasons actually, why longer term collars work better than shorter term collars. This is a tricky question. I don't expect anybody to get this answer. I'm just going to put that out there. But if somebody can tell me both of the answers, and who knows, sometimes I ask questions like this and there's a third answer I wasn't thinking of. But if somebody can give me two reasons why longer term collars work better than shorter term collars. Longer term college is like when you flunk a couple of grades or you party too much and it takes you 5 or 6 years to get your bachelor's degree, which you know, it all works out in the wash. Seas get the grease, as they say. So yeah, if you can give me two valid reasons why longer term collars work better than shorter term collars, there might be a little swag gift in there for you. And no freaking cheating. All right, we got a set of answers. That's it's not what I'm looking for because potential good news, there's potential bad news too. I'm looking for something a little different. Justin says lower theta and premiums closer. Not a bad answer either. Lock in cost and avoid potential volatility. You guys are all thinking. You're all thinking, and you're all thinking good stuff. I'm going to give you a very options nerd mathematical couple of reasons. Reason number one is how vertical skew works. So in a typical stock, the put skew, which is the implied volatility of, let me drag, let me bring my Firstrade screen. Wait, this is my podcast, Wealth Building with Options. I dragged over the wrong thing here. Hold on a second. Put that one back. It's not the one I was looking for. These are not the droids you're looking for. That's not it. I've got way too many screens open here, friends. So let's look at Citigroup stock. Options, Citigroup, get option chain. And we're going to look at Greeks and analytical. And these are the ones that expire in 9 days. So look. Oh, this is a weird one. It's got some funny numbers here. Let me find a different one. AT&T is probably going to be better. Yeah. Okay. So actually, yeah, this one's pretty good. Okay. So look. No, this one's, oh, goodness gracious. I really hate when I do this. I'm looking for a very, very liquid stock that is not like one of the high flyer tech stocks. Okay. Pretty good example. So this is with, I bet I get an even better example now. Okay. So this is usually classically we get higher implied volatility the lower the strike. Sometimes if like a market is a little wider or tighter or something, we can get a little bit of a like, higher vol, lower vol, higher vol. but usually that's just because of the market width. And then as we go to higher strikes, we usually get lower vol, lower vol, lower vol. Either way, overall, the lower strikes, so the puts, have a higher implied volatility than the calls. Now, these are 9-day options. Let's go out to $210-day options. In fact, let's go even further. Gosh, they list so many darn options these days. Isn't it crazy? you well, you have the same thing here, kind of. I don't know. There's the volatilities can get a little bit weird. It depends on a lot of factors. My example is not working out ideally, but normally what happens is with shorter term options, the put skew gets steeper, which means the lower strikes volatility gets higher and higher and higher. But with a really long-term option, it still gets higher with the lower the strike, but not as high. So we're buying a much higher volatility on shorter term puts than we are with longer term puts. And with calls, it's the opposite. Volatilities tend to go lower, but the way the math ends up typically working out is that ends up offsetting prices somewhat, and the collar becomes closer to zero. That's reason number one. And goodness gracious, nobody could have typed that because that was a really long answer. Reason number two is interest. So when it comes to the interest rate and rho, the Greek that is not as commonly talked about, call prices like if you look at in here, let's go back to these, let's go back to this option chain. If we look at the at the money delta, so let's see, the stock is 99.33. If we look at the 99 strike call delta, it's 54. That's with 9 days. But if we go out to 303 days, there is no 99 strike. Let's go back. So if we look at the 100 strike delta at 9 days, it's 46.9. If we look at the 100 strike delta with 300 days, it's 56.6. The call delta is higher on the same strike with more days to expiration. That means the call prices consequently get higher, which balances out the skew even more. And so we end up with a more close to zero cost collar. All right. I had to throw something in there for the nerdy options folks like myself who like to know all these little inner working things. All right, friends. So that being said, options can provide protection, but the cost can be oppressive. So we need to get creative and manage it. And so we can use covered calls to offset the cost of protective puts. All right, friends, I will see you next week where we will talk about why your covered calls don't work. Ooh, now we're going to get even better at a thing that we introduced today. Oh my goodness, it's going to be great. All right, friends, I will see you next week. Have a great rest of your day. Trade smart.